What are consolidated financial statements and how are consolidated financial statements prepared? When reviewing an annual report, you come across the word consolidated everywhere. When browsing the financial statements, Consolidated Statement of Income, Consolidated Balance Sheet, Consolidated Statement of Cash Flows. When reviewing the key metrics, Consolidated Net Sales, Consolidated Net Income. When reading the supplemental schedules, Consolidated Results of Operations, Consolidated Subsidiaries. Let's start off with a definition of consolidated financial statements. The financial statements of a group in which the assets, liabilities, equity, income, expenses and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. Let's illustrate that definition with some examples. When you review the Consolidated Statements of Income of Walmart Inc., you are looking at the economic entity of the Walmart Group, consistent of the parent company Walmart Inc. and a list of consolidated legal entities. When you review the consolidated balance sheets of Apple Inc., you are looking at the economic entity of the Apple Group, consisting of the parent company Apple Inc. and a list of consolidated legal entities. When you review the consolidated statements of cash flows of Tesla Inc., you are looking at the economic entity of the Tesla Group, consisted of the parent company Tesla Inc. and 7 pages worth of consolidated legal entities. The big question here is to consolidate or not to consolidate, or more specifically, who to consolidate and how to consolidate. There is plenty of documentation on the subject of consolidation that outlines the requirements for the preparation and presentation of consolidated financial statements. For US GAAP, ASC 810. For IFRS, IFRS 10. Let's discuss the highlights. Who to consolidate? The core concept here is control. Does the parent company have the power to direct activities of the subsidiary? Does the parent have exposure or rights to variable returns of the subsidiary? In other words, the obligation to absorb losses from or right to receive benefits from, with returns that must vary and can be positive, negative, or both. Usually there is control when ownership and voting rights exceed 50%. However, in certain unusual circumstances, control may exist with less than 50% ownership when contractually supported. This concept is referred to as effective control. If control of a subsidiary is not established, then the investing company still needs to account for the investment through methods other than consolidation, for example using the equity method of accounting, but that's for a different video to discuss. Let's continue on the path of consolidation. After determining who to consolidate, the next question is how to consolidate. To a large extent, it is all one big summation. To prepare consolidated financial statements, combine like items of assets, liabilities, equity, income, expenses and cash flows of the parent with those of its subsidiaries. In addition, there may be the need to eliminate intercompany transactions and intercompany ownership or financing positions. Here are 2 common examples. There may be intercompany sales between entities within the group. For example, if you look at the annual report of the Coca-Cola Company, the line total net operating revenues consists of third-party external revenues as well as inter-segment revenues. In 2019, the Asia Pacific operating segment had $4.7 billion of third-party revenues and $600 million of inter-segment revenues. Let's T-account the journal entries of the intercompany sales transactions using numbers that are obviously not the actual real-life Coca-Cola numbers, as you can find information about the company's consolidated gross margin, but obviously not about the internal transfer pricing. The journal entries for recording intercompany sales in the selling entity are debit intercompany accounts receivable for 70, credit intercompany sales for 70, and debit cost of goods sold for 40, credit inventory for 40. The difference between the amount recorded in intercompany sales and the amount recorded in COGS is the margin of 30 on the intercompany sales for the transferring entity. The receiving entity first books debit inventory for 70, credit intercompany accounts payable for 70. For the receiving entity, the value of the inventory equals the cost of what it purchased the inventory for, which is 70 in this example. This is fine on the entity level, but remember that for the group, no profit is recognized until the sale to an outside party has been realized. Once the receiving entity sells externally, it books debit accounts receivable for 100, credit external sales for 100, and debit cost of goods sold for 70, credit inventory for 70. On the consolidated global level, those inter-segment revenues and margins have to be taken out to avoid double counting. This happens in the eliminations column. What we want to keep to correctly report on the group level are the items circled in red: the external sales and the cost of goods sold based on the manufacturing cost. What we primarily want to eliminate on the group level are the intercompany sales and the cost of goods sold that are based on the intercompany transfer. The transactions in the books of the individual operating segments are kept in place, while in the eliminations ledger, offsetting journal entries are booked to correctly state the group level totals. To eliminate the intercompany sales, a journal entry is recorded debiting the intercompany sales account by 70, crediting the cost of goods sold account by 70. And when applicable, in case not all of the transferred inventory has been sold externally yet, crediting the inventory account. If any transferred inventory is unsold at the end of the reporting period, the credit of the journal entry is split between COGS and inventory, 60-10, 50-20, 40-30, or whatever the actual ratio might be. The debit to intercompany sales eliminates intercompany sales on the group level. The credit to cost of goods sold eliminates the intercompany COGS and therefore the margin. The credit to inventory eliminates the intercompany profit on goods still in inventory, in other words, not sold externally yet. When intercompany inventory on the balance sheet at the end of the period is 0, then the full credit leg of the journal entry goes to COGS. In addition, the accounting team reviews the intercompany accounts receivable and accounts payable balances at the end of the reporting period. If there are any remaining due to, due from balances, then these are eliminated by crediting accounts receivable and debiting accounts payable. The second example of common intercompany elimination entries is intercompany ownership. Let's take the example of a parent company with 3 direct subsidiaries, A, B, and C, and a grandchild, D, which is a subsidiary of C. The parent company holds a balance of $10 billion in the account investment in subsidiaries, on the asset side of the balance sheet. Subsidiary A has $5 billion in equity, held by the parent, B $3 billion, and C $2 billion. The sum of the investment in subsidiaries for the parent is equal to the sum of the equity balances in the subsidiaries. In turn, subsidiary C has an investment in subsidiaries of $1 billion, mirrored by the equity on the balance sheet of subsidiary D. Like in the previous example, the balances in the books of the individual operating segments or legal entities are kept in place, while in the eliminations ledger, offsetting journal entries are booked to correctly state the group level totals. In the eliminations ledger, the account investment in subsidiaries is credited for $11 billion, while the equity account is debited for $11 billion. As a result, for the group, the sum of each of the accounts, investment in subsidiaries and equity from parent, is 0. Similar elimination journal entries would be recorded when there are intercompany loans between parent and subsidiaries or among subsidiaries. So where do you find information about consolidation in an annual report? Go to the notes to the consolidated financial statements, section Principles of Consolidation, and you will find both the who and the how of consolidation. For example, Walmart states that it consolidates variable interest entities where it has been determined that the company is the primary beneficiary of those entities' operations, and that intercompany accounts and transactions have been eliminated in consolidation. Consolidated financial statements, the financial statements of a group in which the assets, liabilities, equity, income, expenses and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. Who to consolidate? The core concept here is control. How to consolidate? Combine like items of assets, liabilities, equity, income, expenses and cash flows of the parent with those of its subsidiaries and record applicable eliminations. Want to learn more about business, finance, accounting and investing? Then subscribe to the Finance Storyteller YouTube channel and start watching the next video in the recommendations on the screen. Thank you.